At 9 in the morning, your money begins disappearing, not from your pocket, from the system. Before you touch your paycheck, before you pay rent, before you buy groceries, your money has already started climbing. Up to lenders, up to banks, up to asset owners, up to the people who charge a fee for letting the rest of us participate. That is the strange part nobody explains cleanly. Most people think money moves in a circle. You earn it, you spend it, someone else earns it, and so on. Neat, fair, balanced. It is not balanced. Money does not really move in a circle. It moves uphill. And by the time it reaches you, a lot of it has been skimmed. It is bundled, taxed, priced, borrowed against, or locked behind systems you never see. That is why people can work harder and still feel behind. Not because they are lazy, but because the route is designed to feed power. Look at the month in simple terms. A company gets paid by customers. That money does not sit still. It immediately hits lenders, suppliers, payroll processors, landlords, credit card networks, software vendors, and banks. Each one takes a cut, directly or indirectly. By the time wages finally reach workers, the flow has already been narrowed. Then the worker gets paid, and the same thing happens again. Income tax is withheld, rent is due, debt payments are automatic. Sales tax hits at the register, interest compounds on whatever was borrowed, subscription fees keep running in the background. The money you receive is not the beginning of the story, it is the residue. That is the first trick. The second trick is that the people closest to money creation get the biggest advantage. When new money enters the economy, it tends to enter through banks, financial markets, and institutional channels. That means the first people to get access to fresh money can spend it before prices fully adjust. By the time that money trickles down, the cost of living has already moved. Same dollars, different timing, very different power. That is why inflation feels unfair. Prices rise after the early receivers have already benefited. Everyone else pays the new price later. This is where the system gets quietly brutal. If you own assets, you are positioned near the top of the river. If you rely on wages, you are downstream. Assets tend to rise with inflation. Debt can be inflated away. Stocks, property, and business ownership often benefit when money becomes more abundant. Wages, by contrast, usually adjust slowly. Imagine a family that gets a 4% raise in a year when rent rises 10%, food rises 8%, and insurance rises 12%. On paper, they got paid more. In reality, they got pushed backward. That is how the economy can look healthy and still feel like a trap. Now add debt to the picture. Debt is not just a financial tool, it is a time machine with a bill attached. When you borrow, you receive money now and repay more later. But the repayment happens in a future where your options may be narrower. For a business or bank, debt is an income stream. For a household, debt is often a survival mechanism. Interest is a beautiful word if you lend money. It is a very different word if you owe it. A bank does not need to take your full paycheck. It only needs its small claim on many paychecks, over and over, forever. That is the quiet genius of the system. It does not rely on one big theft. It relies on many small, legal, ordinary extractions. That is why most of the machinery feels invisible. Instead, the system offers convenience. Swipe here, auto pay there, buy now, pay later, finance the rest, minimum due. It all sounds civilized, almost elegant. But underneath, it is a chain of toll booths, and the toll booths are everywhere. At the grocery store, at the gas station. At the bank, your deposit becomes raw material for lending. At your job, your labor creates value long before you see the paycheck. Even your paycheck is not fully yours when it arrives, because parts of it have already been claimed on the way. This is why people can feel exhausted without one obvious villain. There isn't one. There is a structure, a layered one. A system of claims that moves first toward institutions, owners and creditors, and only then toward everyone else. That is the hidden math. Money prefers speed, scale, and leverage. Power has all three. A large institution can borrow cheaply. It can spread costs. It can negotiate terms. It can wait longer than you can. Time is a luxury asset. If you have cash reserves, you can survive delays. If you live paycheck to paycheck, delays become damage. A missed payment becomes a fee becomes interest becomes a cycle, and the cycle becomes normal. That is how systems maintain themselves without force. They just make dependence feel standard. Now people say, just invest, just start a side hustle, just learn financial literacy. There is truth in that. But that advice can also become a distraction. Because the deeper issue is not that people failed to optimize their way out. The system is built so that optimization mostly happens after the biggest gains have already been allocated. A person can do everything right and still lose ground if the structure is taking more than they can recover through wages. You hear about easy money, fast gains, passive income, infinite leverage, a market that always goes up. For a while, it can all look brilliant. Then rates rise. Then liquidity tightens. Then layoffs hit. Then asset prices stop rising fast enough. Then the bill comes due. The same system that made people feel clever on the way up can make them feel cornered on the way down. Power does not just receive money first. It also shapes the rules when the flow changes. It can refinance. It can roll debt. It can bargain for bailouts. It can buy assets when everyone else is forced to sell. That is how downturns often become transfer events. Pain on the bottom, opportunity at the top. Why does your paycheck vanish so quickly? Because it carries the burden of claims created long before you saw it. Why does debt feel sticky? Because the system earns from your continued obligation. Why do asset owners seem to get richer when everything gets more expensive? Because the rise in prices protects their wealth. Why does the whole thing feel like you are running in place? Because in many cases, you are. This does not mean money is fake or effort does not matter. It means effort alone is no match for a system that roots value upward. Modern economies are built to keep the machine moving, and machines are very good at rewarding the parts that control them. So the real question is, who gets to stand nearest the source before the rest of us even see the current? Because once you understand that money moves uphill, a lot of economic life stops looking random. It starts looking like a map. If the route is already built, how much of your future is about earning, and how much is about where the money flows before it leaves your hands?